Think back, if you can, to a time when the financial news just felt like constant bad news. Maybe 2008,
Oh,
when
yeah,
it really seemed like a whole global economy was teetering.
absolutely. And right at the heart of that earthquake, really,
Hmm.
was the collapse of Lehman Brothers. Just stunning.
Exactly. So that's what we're diving into today, the fall of Lehman Brothers. We're looking at Sneha Mali's article, The Fall of Lehman Brothers, how misjudging the housing bubble led to financial catastrophe. It just came out.
It's a great piece. Really lays things out clearly.
So our goal here, our mission, let's say, is to figure out how this giant financial institution, seemingly invincible, right?
Right.
How could it just crumble like that? And what are the lessons, the big takeaways for us? We want to pull out the key stuff from the article without getting lost in the weeds.
Makes sense.
Okay, so where do we even begin? It's such a huge story.
Well, a good place to start is probably Lehman's big bet on the U.S. housing market. That's really central. The article points out they invested heavily, I mean massively, in mortgage-backed securities and CDOs,
Uh-huh.
collateralized debt obligations.
Right, those complex things everyone was talking about back then. The article explains they basically took loads of home loans,
Mhm.
including those riskier subprime ones,
Yeah, the subprime mortgages.
bundled them all up and sold them as investments. And the whole thing rested on this idea that U.S. housing prices would just, well, keep going up forever.
Exactly. That was the fundamental assumption. The thinking was, even if some people defaulted
Uh-huh.
because the loans were from all over the country and house prices were rising everywhere, it wouldn't really matter overall. The diversification and rising values would cover the losses,
Like a safety net.
supposedly.
Yeah.
But the big blind spot, the fatal flaw really, was not seriously, considering that house prices could fall everywhere at the same time.
That systemic risk idea.
Precisely. Systemic risk. They didn't properly account for it.
It's like they were looking at the trees, but completely missed the forest fire heading their way. And the article says there were warning signs, even back in 2006.
Yeah, there were. You started seeing more and more defaults on those subprime loans. Delinquencies were rising.
But Lehman didn't pull back.
No, quite the opposite. They actually doubled down. They invested more.
Wow. Okay, that's a big moment.
It really is. By 2007, the article states Lehman was holding something like over $100 billion in real estate assets.
100 billion.
Yeah. And a lot of it was illiquid, meaning, hard to sell quickly without taking a huge loss.
So they were stuck with it if things went south.
Pretty much.
Yeah.
And the leadership, they seemed to think any downturn was just temporary, a blip.
By the dip, right.
Kinda, yeah. They saw it as a chance to scoop up assets cheap and wait for the rebound. It really points to a level of overconfidence.
Or maybe just not wanting to admit they might be wrong. Or take the loss.
That too. A reluctance to accept losses. This huge pile of illiquid assets just made them incredibly vulnerable. It wasn't just a number, it was a critical weakness.
And when that bubble finally did burst,
And boom, those assets turned toxic fast. Their value collapsed.
and Lehman's balance sheet just got shredded.
Exactly. And suddenly, nobody trusted them anymore. Other banks, investors, their credibility just vanished, almost overnight.
But the article suggests it wasn't just about misreading the market, right? There were internal things going on, too.
Absolutely. Misjudging housing was the trigger, no doubt. But Lehman's own internal workings, especially their use of leverage borrowing and a culture focused on short-term profits, those were critical fuel for the fire.
Okay, leverage. Let's break that down. The article mentions a leverage ratio over 30 to 1 in 2007. What does that actually mean for, regular people trying to understand this?
Right. Think of it simply. For every $1 of their own money, Lehman was controlling over $30 of assets. They'd borrowed the rest.
30 times their own capital.
Yeah, it's huge. Now, this magnifies everything. If asset values go up, profits soar. What?
If they go down.
Losses get magnified just as much. So when those mortgage securities started losing value, even a small drop wiped out a massive chunk of Lehman's own capital cushion.
Because they had so little of their own money in the game compared to the total assets.
Exactly. They didn't have enough buffer to absorb the hits. And then, crucially, their access to short-term loans, the money they needed day to day, just dried up. Liquidity vanished. That 30 to 1 wasn't just a number, it was like a ticking bomb.
Wow. So even a small wobble in the market could push them over the edge. It sounds incredibly fragile in retrospect.
It was. And the article also digs into their risk management, or maybe the lack of it.
What went wrong there?
Well, basically, the risk management teams couldn't keep up. The investments Lehman was making were getting more and more complex.
Like those CDOs we mentioned.
Right. And according to the article, risk officers did raise red flags. They warned about the housing exposure.
But they were ignored.
Seems like it, or at least downplayed. Senior execs were really focused on revenue growth, on market share, short-term wins.
And the real estate division was making a lot of money for them, right?
Huge profits. So that division had a lot of clout internally, maybe too much. Objective risk assessments sometimes took a backseat to, closing the next big deal.
It sounds like the whole incentive structure was warped, rewarding short-term performance over long-term stability.
That's a key point the article makes. If your bonus depends on this quarter's profits, you're maybe less worried about a potential crash 2 years down the line.
Yeah, you take the risk now, get the bonus now.
Precisely.
Yeah.
So you end up with this really dangerous mix. A culture that didn't properly value risk management, underestimated the chance of a total market collapse, and then layered on top this massive leverage. It was, a perfect storm waiting to happen.
A perfect storm. Which brings us to that really controversial moment, the decision not to bail Lehman out. Unlike Bear Stearns earlier or AIG later, why let Lehman fail?
Yeah, that's still debated fiercely today. The article presents the official reasons given at the time by the Treasury and the Fed.
Which were?
Essentially, they argued they didn't have the clear legal authority to step in the same way. Or they couldn't find a buyer. Remember Barclays?
Right, the British bank. They were interested.
They were, but the talks collapsed. The article mentions UK regulators got nervous and wouldn't approve the deal unless the U.S. government basically guaranteed Lehman's dodgy assets.
And the U.S. government said no.
They blinked or decided they couldn't.
Oh.
So no buyer, no bailout.
And the fallout. Immediate chaos, wasn't it?
Oh, absolutely catastrophic. The article describes it well. Global markets just panicked. Credit completely froze up. Banks stopped lending to each other. Businesses couldn't get loans. Confidence just evaporated.
It wasn't just Lehman, it spread everywhere.
Instantly, it was a chain reaction. So many other firms, banks, insurers, pension funds, even money market funds that people thought were safe as cash. They all had exposure to Lehman. They lent Lehman money or held its debt or relied on it for funding. When Lehman went down, it triggered losses right across the system.
It really starkly showed how interconnected everything was. This shadow banking system, as they call it, was suddenly visible and looked really fragile.
Exactly. And the article touches on the two sides of the bailout debate, too.
Yeah, the moral hazard argument versus the idea that letting them fail made things much worse.
Right. One side says, look, if you bail everyone out, they'll just keep taking crazy risks knowing taxpayers will save them. Letting Lehman fail taught a harsh but necessary lesson.
Discourage future recklessness.
That's the idea. But the other side says, well, okay, maybe, but the cost of that lesson was immense. It arguably turned a serious crisis into a global meltdown. Was it really worth it?
It's tough, really complex. No easy answers there.
None at all. And the article does a good job just presenting those arguments.
So, stepping back from the brink, looking at the whole picture, what are the big lessons here? What should we really take away from Lehman's collapse?
I think the article boils it down well. Yeah. The number one lesson is probably the danger of just unchecked risk-taking, especially when it's fueled by chasing short-term profits.
Don't put all your eggs in one basket, especially if you borrowed the basket and the eggs.
Yeah, something like that. Lehman's over-reliance on housing, combined with that massive leverage and this almost blind faith that they knew best, it's a textbook case of how things can go wrong.
And it did force some changes, didn't it, in terms of regulation?
Oh, definitely. The
Yeah.
crisis was a huge wake-up call. The article mentions the Dodd-Frank Act in the U.S., which was a direct result. The whole point was to make the system more transparent, beef up risk management, and figure out how to handle failures of big firms without causing another meltdown.
What kind of specific things came out of that? Stress tests?
Exactly. Stress tests became standard practice, basically simulating bad scenarios to see if banks could survive.
Okay.
And regulators demanded banks hold more capital, more liquid assets, stuff they could sell easily in a pinch, more cushion.
And this idea of living wills.
Right? Big, important financial firms now have to create plans for how they could be wound down in an orderly way if they got into trouble. So it wouldn't be the same panic as Lehman.
So the collapse, as awful as it was, did push regulators to build stronger defenses.
It did. The article frames Lehman as this ultimate cautionary tale about overconfidence, bad judgment, ignoring those extreme tail risk possibilities. It shows what can happen.
No matter how big you are.
No matter how big. And it really highlights how important it is for regulators to be vigilant, especially when markets look bubbly. and how costly it can be if they don't act soon enough.
Which brings us to the fast fact in the article. Lehman Brothers files for bankruptcy, September 15th, 2008.
Yep.
Assets over $600 billion,
Yeah.
still the largest bankruptcy in U.S. history. And, as the article says, a key trigger for the whole global crisis. Just staggering.
Puts the scale of it right there, doesn't it? $600 billion.
It really does. Okay, so wrapping this up, this deep dive, using Sneha Mali's analysis, it really drives home those key points. Betting too big on one thing, borrowing way too much, letting short-term thinking cloud judgment, and the ripple effects when something that big goes down, plus the regulatory reaction trying to prevent it happening again.
Absolutely. And it leaves us with a pretty critical question, I think, for you listening.
Mm-hmm.
We saw with Lehman how interconnected things were, how problems could spread.
Yeah.
So the question is, how might seemingly small or isolated events happening today carry some kind of hidden systemic risk that we're not seeing yet, given how complex everything still is?
Yeah. Yeah, that's definitely something to think about. Food for thought.